Hi, and welcome back to the Food Fund, where we analyze investing in food, beverage, and restaurant stocks. Is a popular plant-based beverage company a good investment? In this video, we will be analyzing if Oatly stock is a buy. Can Oatly, stock ticker symbol OTLY, regain its former glory? Let's find out. We have so much to cover, so let's go ahead and jump right in. Cue the logo. Let's start off with the price action. Looking at the one-year chart, we see that Oatly had a CAGR of about minus 34%. Zooming out to the 5-year chart, we see that Oatly had a CAGR of minus 57%. Oatly has been a big loser over the long term, but has been less bad recently. Is this the beginning of a turnaround? Now let's hop over to market share and take a look at Oatly's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under Beverage and see that Oatly is categorized as a non-alcoholic beverage company. Expanding the non-alcoholic beverage tab, we can see that Oatly has the second smallest market share of the companies in this category, but the green color indicates that the company is growing its market share. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for Oatly, OTLY, and see that the market share is 0.1% out of the publicly traded food, beverage, and restaurant stocks currently in the market. There is not a lot of spend on Oatly, but it has been increasing over time. The 5-year market share CAGR for Oatly is 3.72%. This means that Oatly has gained market share over the past 5 years. If we start in 2021, we see that the market share was 0.088%. 0.09% in 2022, 0.093% in 2023, 0.1% in 2024, and 0.1% over the trailing 12 months. Though the market share has increased over the past 5 years, it did peak in 2024. This could spell trouble on the horizon. Let's take a look at the fundamentals to learn more. Gross margin is 30%. This is actually pretty good for a new beverage company. Revenue has compounded at around 8% over the past 5 years and has grown to $822 million most recently. Sales had grown at an acceptable rate, but with revenue peaking in 2024, I'd be less confident in growth continuing. When we look at cash flow, we see that operating cash flow has improved at a 24% CAGR over the last 5 years. CapEx has improved at a 45% CAGR. As a result, free cash flow has also improved at a 36% CAGR during this time period. Still, both operating cash flow and free cash flow are negative and indicate that the company may never be able to cross over into the promised land of cash flow profitability. Weighted average shares outstanding have increased over the last 5 years, going from 22.7 million shares in 2021 to 29.9 million shares most recently. Oatly has been aggressively diluting shareholders. To be fair, the rate of dilution has slowed drastically since 2022, but dilution still hurts shareholders. Now let's view return on invested capital. Return on invested capital has improved from minus 29% in 2021 to minus 11.8% most recently. While still negative, the trend for this metric is moving in the right direction. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage, as well as inventory control. Going from 54 days in 2021 to 58 days most recently, Oatly has actually gotten less efficient over time, and the trend is continuing in a bad direction. Now let's look at Oatly's debt. The net debt to EBITDA has decreased over time, going from 2.2 in 2021 to minus 5.2 most recently. Given that the company is unprofitable, this value means that their debt is mounting and earnings are slipping further. Last, let's compare performance to the benchmark. If we perform a backtest comparison of investing $10,000 in Oatly versus the S&P 500, we find underperformance for Oatly. In that comparison with the S&P 500, $10,000 invested in Oatly would have shrunk to $746 versus $13,676 if invested in the S&P 500. This is an annualized return of minus 52.37% for Oatly versus 9.36% for the S&P 500. An Oatly investment would have been much more volatile, with a 77.23% standard deviation versus 16.98% for the S&P 500. Oatly underperformed the S&P 500 in terms of the best year performance, for which Oatly grew minus 10.46% versus S&P 500 26.19%, and worst year performance, where Oatly fell minus 78.14% versus the S&P 500 minus 18.17% fall. In terms of max drawdown, Oatly fell 93.91%, more than the max drawdown of 23.93% for the S&P 500. Oatly also massively underperformed the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio. The Sharpe ratio for Oatly was minus 0.64 versus 0.38 for the S&P 500, and the Sortino ratio was minus 0.95 versus 0.57 for the S&P 500. Oatly has been trailing the S&P 500 for a long time by nearly every metric. Even more shocking is that Oatly's best year was a 10% loss. Sheesh! Oatly stands alone as a pioneer of milk alternatives. In any event, is it a buy? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Oatly. It is a beverage company with a gross margin of 30%. The 5-year revenue per share CAGR is 5%. And the 5-year free cash flow per share CAGR is 27%. The gross margin is actually great, and improving revenue and free cash flow is a good, if you forget that free cash flow has been negative for a very long time. A return on invested capital of minus 12% is bad. Next, the cash conversion cycle of 58 days is high and trending to move even higher. Concerning debt, a net debt to EBITDA of minus 5.2 means that Oatly is still unprofitable and has massive amounts of debt. So from a fundamental standpoint, Oatly remains a very bad company. Now let's switch our attention over to valuation. The price to earnings growth, or PEG ratio, cannot be calculated because Oatly is unprofitable. Oatly was founded in 1994 in Sweden by two brothers who were doing research at Lund University focused on creating milk alternatives for those with lactose intolerance. Fast forward to today, Oatly offers a diverse range of items including various oat milks, oat-based yogurts, ice creams, and spreads. With almost 1,500 employees, Oatly's global operations are still headquartered in Sweden. While the company has certainly captured a loyal fan base, their great products aren't translating to a great stock. We've seen revenue peak, and the company has also been grappling with negative operating cash flow. In fact, when we look at the data, we see just how bad it really is. Total debt has ballooned to $476 million, while they only have $74 million in cash. With a burn rate of $129 million per year, Oatly will go bankrupt by the end of 2025. This is a big red flag for investors, as it indicates the company will need to raise more capital, which could dilute existing shareholders. The reverse stock split that took place in February 2025 leads me to believe that management will attempt to do a second share sale to raise more funds at some point in Q3 or Q4. So while the products might be delicious, the financials suggest the company is a dud for the rest of the year. Overall, I give this company a 4 out of 10 using my proprietary scoring system. I like Oatly, but the risk to invest is too high. Many thanks for watching. What do you think about Oatly? Share your thoughts below. It is always great to hear from you. Check out some more videos right now, and don't forget to put your money where your mouth is.